Turning to the markets, Jack Hough, Smart Money Magazine. You have a piece, you're coming up with ways to not be happy about the stock market. Now, here's the piece. Less unemployment, I forget, hang on, I'm going to get the exact title of the piece. Do you have it, Jack?
I just want to say writers do not write headlines.
I understand that, but
a lot of people don't realize that. Editors write headlines.
Yeah, I know. So blame it on your editor,
Yeah.
Jack. But job growth may be bad for stock returns. This is the equivalent of saying like, sunshine may be bad for your health or something like that. Job growth is bad for stock returns.
We have to distinguish between short-term and long-term. Long-term, we want everyone who wants a job to go back to work. That'll give them more income, they'll buy more stuff, companies will be more profitable, and our share prices will move higher. However, in the short term, take a look at what has happened. Stock prices have jumped because earnings have jumped. Double-digit earning growth the past couple of years. Where has that come from? It's come from companies expanding their business without taking on more workers, even getting rid of workers. Keep in mind that labor for many companies is about 70% of their costs, right?
Really?
So in the
that much still?
Yeah, for a lot of companies.
I mean,
not if you're an energy company or something like that.
Not for an Apple, it's not, and not for but Walmart. A lot of the big employers, I'm sure, have a large McDonald's. Probably labor cost is a big chunk.
And if you take a look at what's happening in the figures, first of all, the productivity. If you look, it's slowed. We had this,
Productivity growth has slowed.
Productivity growth has slowed from 4% to less than 1%, right? Earnings, if you take a look, the projections for earnings growth are a lot slower going forward. The upside surprises are fewer and smaller than they have been in the past. The revisions, more downward revisions.
So you have this very counterintuitive observation, which is given better employment, and here we have some employment numbers, JR. Are you going to pop those up there for us? As the employment picture has brightened, earnings growth has lessened, and here we have basically the chart of unemployment since the recession ended. And of course, in July, from March of 2009 through March of this year, we've had tremendous earnings growth, largely because, frankly, there were huge losses on the financial institutions front going back to 2008 and 2009. Does this maybe portend a Goldilocks economy and Goldilocks type profits over the next couple of years?
I think
Am I getting too far ahead of myself here?
I think the stock market might be, not getting too far ahead of itself, but I think it's captured. It's right up to par with the earnings growth we've seen, and the earnings growth is slowing, and I think the stock returns will slow. It doesn't mean the stock market is going to plunge, but if you look at the jobs numbers, they're good. I think it suggests that companies have reached the limits of the productivity growth of their workers. I mean, I see you working hard over here. You're working hard enough, right?
Yeah.
So
good point.
We're going to see more.
Next time you see some of the powers that be, you tell them that.
If you have to have one or the other, you'd rather have the jobs growth now because the stock returns will come. But I just think that in the short term, you're certainly not going to see this explosive earnings growth that you've seen in the past couple of years. I think returns can slow.
And one of the questions that we grapple with all the time here, can you have an increase in the stock market? Can the stock market values go up even if you don't have earnings growth? Historically, our experience would say you cannot have that. And yet what we do see is that certainly relative to historical trends, the earnings multiples have been very let's call it very conservative. So we do have stocks trading at much lower multiples than they have historically, given, say, the recent earnings growth. Isn't that true?
Yeah, I mean short-term, long-term. In the short term, investors can become ecstatic or gloomy, and valuation levels can change. But one of the most powerful forces you see in finance is reversion to the mean. So eventually, if valuations get too far out of whack, they tend to come back. And over the long term, the market does tend to track that earnings growth.
And
it can't move away from it forever.
And once you get jobs growth, theoretically, you get income growth. You get spending growth, and spending at the end of the day, right, is the driver. For
long term, this is good for everyone. Short term, you could see your returns slow down a little bit.
Right. So what's your mood today as we head into the 3-day weekend, Jack? What is Smart Money Magazine telling the smart money out there?
I'm a New Yorker, so my mood never gets great. It goes up to, it tops out at good.
Yeah.
But I'm in a good mood.
You're in a good mood.
Stocks 14 times trailing earnings, decent dividends. The economy seems to be picking up. I think there's decent news out there for people. I'm not gloomy.
You're not gloomy. You're only moderately grumpy, as in New York.
A little grumpy.
Jack Hough, thank you very much. Smart Money Magazine.